Welcome to the Daily Block, the top events from the last 24 hours in crypto and why they actually matter to degens with margin accounts. Monster Bitcoin short squeeze alert, about $16 billion of shorts at risk. Liquidation heat maps are lighting up. Roughly $16 billion of leveraged BTC shorts are clustered around the $115,000 zone, while Bitcoin sits near 113 to 114K. Spot ETF inflows plus a friendly macro print have nudged price right into that danger corridor. If price punches clean through 15K and holds, those stacked shorts could get steamrolled into a violent intraday short squeeze and classic blow-off spike. Why it matters for crypto investing: short squeezes are the easiest way to vaporize leverage positions and create massive intraday volatility that traders can exploit or get wrecked by. Risk/counterpoint. Exchanges can throttle liquidations, big sellers can absorb moves, and an ugly reversion would torch anyone over-leveraged. Don't be the bag holder waiting for a retest. Quick transition. Smell that smoke? Let's fan it. BlackRock's crypto holdings top $100 billion, 740.5K BTC plus 3.667 ETH. On-chain sleuths at Arkham show BlackRock-controlled addresses now hold north of $100 billion in crypto, a dominant BTC stash and a hefty ETH position, even though ETH inflows have cooled a bit lately. This is not retail FOMO. It's programmatic accumulation via ETFs and custody vehicles at institutional scale. Their cadence of buying and selling can slowly reshape liquidity profiles and volatility regimes across markets. Why it matters for crypto investing. Large, repeatable institutional flows mean structural demand under prices, which changes risk models for everything from futures funding to rebalancing algorithms. Risk counterpoint. Institutions can also be sellers, and concentrated wallets can dump into thin spots. Institutional presence reduces some risks, but introduces counterparty and execution risk. Moving along, more macro juice. Macro, US jobless, claims, spike, rate cut pricing, reignites crypto rally. Initial jobless claims jumped to a 4-year high, spooking macro desks and pushing markets to price in Fed easing sooner than expected. Risk assets cheered. BTC popped toward 114K and ETH cracked $4,400 as yields fell and liquidity hopes rose. Short term, macro prints and shifting Fed expectations remain the main drivers of leverage flows into crypto. Why it matters for crypto investing. Macro beats and misses move flows into risk assets faster than most on-chain metrics. Position sizing around CPI, PPI, and next week's FOMC is non-optional. Risk counterpoint. Macro is fickle. One strong jobs print or hawkish Fed comment, and the rally can implode. Size for pain. Next up, pump and puree. Linear token airdrop plus exchange listings. Massive pump, then 85% crash. Linear dropped tokens to about 749,000 wallets and got exchange listings, which fueled an initial all-time high, followed by heavy whale selling that dumped the token about 85% from peak amid launch hiccups. Classic airdrop liquidity trap, a ton of token recipients, concentrated exchange flows, and immediate exit pressure from early movers. The initial pop is noisy and fast. The rot follows just as quick. Why it matters for crypto investing. Airdrops and instant listings are gamma mines. Massive short-term opportunity, but engineered to pummel anyone who trades, size, or holds into the first correction. Risk counterpoint. Sometimes projects survive and recover, but most airdrop pumps end with exhausted bids and a long, ugly chill. Micro transition, meme coin ticker. Incoming. Doge ETF live. Meme coin ETF mania. Doge drives Doge pump and short squeezes. The first US meme coin ETF, Rex Osprey, Doge ETF Doge, went live, and Doge surged into the mid-$0.20s on heavy volume and concentrated whale accumulation that triggered big liquidations. When meme infrastructure meets ETF rails, you get sudden, institutional-scale liquidity flows into assets that were previously pure chaos. Short books got squeezed, longs got greedy, and volatility spiked like a fever. Why it matters for crypto investing. Meme coin ETFs create new short squeeze vectors and intraday gamma. If you trade meme coins, expect erratic, extreme moves and crowded books on both sides. Risk counterpoint. Meme coins are still largely sentiment games. ETFs don't make fundamentals. Flash dumps and regulatory attention can reverse the party in an instant. On to DeFi infra. Less ape, more brain. Project Zero launches. DeFi prime broker with unified margin on Solana. Project Zero just launched on Solana, offering a unified margin layer across venues like Drift, Camino, and Jupiter, letting traders net positions across platforms and reduce isolated liquidations. This is essentially a DeFi prime broker. Better capital efficiency, consolidated risk, and fewer accidental cascade liquidation when one venue glitches. For active derivatives traders, it's a legit product that changes how leverage behaves on-chain. Why it matters for crypto investing. Unified margin can compress funding rate arbitrage, change liquidation dynamics, and unlock more capital-efficient trading strategies. Risk counterpoint, protocol risk, cross-venue exploits, and concentrated logic bugs are real. A single exploit could wipe organized liquidity. Shift to corporate treasuries, buybacks incoming. Foundations and corporates building crypto treasuries, Avalanche, Injective, Tron, Forward Industries, $1.65B. Pipe, Avalanche, Injective, and Tron foundations and several corporates are seeding treasury arms to buy tokens programmatically. Forward Industries closed a $1.65 billion pipe intending a Solana treasury strategy. It's not casual accumulation, these are structured buybacks and treasury vehicles aiming to be persistent buyers, which can compress supply and support higher floors over time. Why it matters for crypto investing. Programmatic, foundation-backed buying is a potential multi-month supply shock for select alts, turning narrative strength into real liquidity support. Risk counterpoint. Execution matters. If funds slow or market sentiment sours, those treasuries can turn sellers or sit idle, nullifying the thesis. Last stop, whale governance plays. Arthur Hayes buys yen 995k Athena, ENA, ahead of USDH stablecoin vote. On-chain data shows Arthur Hayes bought roughly 578k ENA on September 10th, bringing his total to about 0.25M. ENA right before a validator vote around USDH and Hyperliquid. Athena is positioning as a USDH frontrunner, and there are whispers of institutional backing in play. Whales buying governance tokens ahead of stablecoin rollouts is classic positioning. If the vote to our listings go their way, prices can gap fast. Why it matters for crypto investing. Governance and stablecoin votes are high-impact catalysts that can produce rapid, speculative squeezes. Insiders jockeying ahead of votes is a legitimate signal. Risk/counterpoint. Votes can fail, Listings can be delayed, and the market often prices in outcomes that don't materialize. Don't over-leverage on a vote. Quick trading takeaways before you reload your FTX-branded stress ball. Macro prints, plus ETF flows, plus concentrated leverage are still the dominant intraday drivers. Map liquidation heat maps and ETF flows before you size a bet. Airdrops, new listings, and meme coin ETFs are the highest gamma plays. Use tiny size, tight stops, and expect instant whale dumps. A new infrastructure like prime brokers and treasury vehicles is structurally bullish for alt liquidity over months, but execution risk makes these trades non-trivial. If you want to follow up, I can flag live price levels and liquidation zones to watch for BTC, ETH, Doge, and Sol, or I can pull recent ETF inflow numbers and on-chain whale buys for an alert. Which would help you most? Hit subscribe if you like getting this spicy nonsense every day. That's Today in Crypto, where the gains are imaginary and the pain is real.